Before we start, let me ask you three brutally honest questions. Type your answers in the chat. First, do you work 996 every day, work harder and harder, yet your bank balance never seems to grow? Second, do you think a raise from your boss or a higher paying job would solve all your money problems? Third, do you think the home you bought by draining six families' savings for the down payment is your biggest asset? If you answered yes to all three, congratulations, you're stuck in a vicious cycle called the rat race. Today's book is a global personal finance sensation, Rich Dad, Poor Dad. Since its publication in 1997, it's been translated into 51 languages and sold more than 32 million copies worldwide. Robert Kiyosaki used the stories of his two dads to deliver a brutal slap in the face to traditional ideas about money. Today, let's break down how this book can actually help ordinary people like us. Part 1. Two Dads, Two Destinies. Kiyosaki had two dads. One was his real father, whom we'll call Poor Dad. Poor Dad was a brilliant scholar, a PhD from a top university, and a senior government education official. He earned good money, but worried about money his whole life and left behind a pile of bills when he died. The other was his best friend's father, his rich dad. This man never even finished middle school, yet through investing in business, he became one of Hawaii's richest men and left tens of millions of dollars behind. Why was the highly educated high earner poor, while the man without a degree became rich? Because their basic operating systems for money were completely different. Poor Dad taught Kiyosaki from childhood. Study hard, get good grades, and find a safe, stable job. Rich Dad said, learn how to make money work for you. Don't work for money. The clearest difference came when they wanted something they couldn't afford. Poor Dad would sigh and say, I can't afford it. Rich Dad banned that phrase. He insisted on asking, how can I afford it? He said the human brain is the best computer in the world. The more you use your mind, the more money you can make. Saying you can't afford something too quickly is just mental laziness. Part 2. What you think is an asset may actually be a liability draining you dry. Kiyosaki says school teaches expertise but never financial intelligence. That's why many highly educated people become financially illiterate. Afraid of running out of money, we work like crazy. Then payday comes, and greed and desire send us shopping. The money disappears, so we have to work like crazy again. That's the rat race. To break the spell, you must understand the book's most important and controversial idea. Know the difference between an asset and a liability. The rich buy assets. Poor and middle-class people buy liabilities they mistake for assets. Kiyosaki's definition is simple enough for a child. An asset is something that puts money in your pocket. For example, rental property, dividend-paying stocks, or a business that earns money without your daily involvement. A liability takes money out of your pocket, like a luxury car, bought on credit, designer bags, or the home you bought with everything you had. You heard that right. You think your home is an asset. Kiyosaki bluntly says that if you live in it, the mortgage, maintenance fees, and repairs keep draining money from your pocket. In terms of cash flow, it's a liability, plain and simple. Only when you rent it out and the monthly rent covers the mortgage and leaves a surplus does it become a real asset. Poor people spend what they earn. The middle class buys liabilities like nicer cars and bigger homes, thinking they're buying assets. The rich use their earnings to buy assets first. Once those assets generate money, they use the income to buy bigger homes and sports cars. Change the order and your whole life can look different. Part 3. Which quadrant are you working in? To explain how ordinary people can get ahead, Kiyosaki introduced his famous Cashflow quadrant. See which box you're stuck in. Top left is ease. You work for someone else, trading time for money and seeking security. Stop working, and your income stops too. You also pay the most taxes. Bottom left is S. Maybe you run a small shop or work as an independent lawyer. You think you're the boss, but you've really just created a job for yourself. You're still the core of the business. Take a day off, and you don't get paid. Ordinary people struggle on the left, while the wealthy build on the right. Top right is B. You own a system and hire people smarter than you. Even if you vacation in Hawaii, the company keeps making money. Bottom right is I. The highest level of wealth, where your money works for you. You use leverage to completely separate your time from your income. To achieve financial freedom, you have to find a way to cross over to the right. Kiyosaki's advice is to mind your own business. Don't get me wrong, that doesn't mean quitting your job tomorrow. Keep your day job, but use your spare time to build your asset column. Buy stocks, start a side business, or invest in rental property, and gradually shift your focus to the right. McDonald's founder Ray Kroc once asked students what business he was really in. They said hamburgers, but he replied real estate. The burgers were just the business. Buying prime locations at every intersection was his real asset. Part 4. If you want to get rich, upgrade your financial intelligence first. Kiyosaki repeatedly says that rich people don't work for money. They work to learn. When choosing a job, young people shouldn't focus only on the salary. They should ask what skills it can teach them, such as sales, marketing, and communication. At the same time, you need to improve your financial intelligence. It's not some vague concept. It consists of four practical skills: accounting, investing, understanding the market, and knowing some basic law. The wealthy use companies as legal entities to reduce taxes legally. Ordinary employees earn money, pay taxes, then spend what's left. A wealthy person's company earns first, treats some costs, like cars and meals, as business expenses, then pays tax on the remaining profit. That's not just crushing the competition. It's simply making smart legal use of the rules. Part 5. Don't blindly believe every book. Think critically and take what works. But before you rush out to borrow money and buy property, hold on. As a personal finance classic, this book still has its flaws. Financial experts like John Reed and Ramit Sethi have criticized it harshly, saying it contains many factual errors and very few practical steps. It may even encourage highly leveraged real estate speculation, which is extremely dangerous during an economic downturn. Ramit went further, saying Kiyosaki recommends certain high-risk penny stocks and even encourages people to deal with notorious pyramid schemes to practice sales. That's basically telling people to walk straight into a fire. More interestingly, in 2012, Kiyosaki's own company, Rich Global, filed for bankruptcy protection after being unable to pay partners more than $20 million. His legal separation protected his personal assets, but it still shows that even an expert's methods don't always work. Also, America's tax laws and real estate policies differ greatly from China's. Copying them blindly can cost you dearly. So remember, blindly believing a book is worse than reading none at all. Don't treat this as an investment instruction manual. Treat it as an introduction to the right financial mindset. In short, Rich Dad Poor Dad's key message is this: your wealth isn't determined by how much money you make, but by how much you keep and how long you make it work. If ordinary people want to change their lives, start today. Stop buying liabilities that merely look impressive. Start focusing on your asset column, learn to distinguish fear from greed, and build your financial intelligence. Even if you invest only a few $100 each month in cash flow producing assets, you're already finding your way out of the rat race. Changing your mindset is the first step toward financial freedom. If today's breakdown helped you, don't forget to like, follow, and save this video. Send it to that friend who works overtime every day but is still broke. See you next time, and I hope you soon own assets that generate income.